Good evening, class. Today we're going to talk about double entry bookkeeping. In effect, how do we record transactions in modern day accounting under the accrual system? So first, let me just show you the accounting equation. It's assets equal liabilities plus net assets. Assets are what you own, like cash, accounts receivable, and inventory. Buildings, whatever. Liabilities are what you owe, and accounts payable is the most common accounting account. And then net assets are what you've managed to accumulate. Unrestricted, temporarily restricted, and restricted. Unrestricted is where you'll find almost all the revenues and all the expenses. Temporarily restricted are those things that are revenue that has been temporarily put on hold for a while for some reason. And restricted is permanent. It cannot be spent. So let's just record transactions. On January 1, in this small nonprofit, the executive director has to pay the salaries, and it's $1,000. So you minus cash, $1,000. So on the left side of the equation, you're minus $1,000. So that means on this side, you have to be minus $1,000. So it's an expense. An expense goes under unrestricted. $1,000 expense. Pretty simple. So let's do something a little more complicated. On the 2nd of January, he decides to order some supplies from Staples. He orders $50 worth of supplies, and he doesn't pay for it. So it's $50 in the asset type, and on the accounts on liabilities, he owes $50 to Staples. So it's a plus $50 in inventory, it's a plus $50 in accounts payable. So on January 5th, he decides to pay Staples, and of course that means minus $50 in cash. The other thing that happens, though, is that on the other side of the equation, he's paying off his accounts payable, so it's minus $50. It's not over yet. On the 10th of January, he gets a revenue of $2,000 of cash, so it's plus $2,000. And it's a revenue that he's not allowed to spend from this foundation until next year. So it goes clear over here in a revenue as temporarily restricted $2,000. It's not a revenue in unrestricted. It's $2,000 in temporary restricted. A few days later, he gets $1,500 from a corporate sponsor, and that corporate sponsor says, spend it any way you like, as soon as you like. And so that's $1,500 under revenue, under unrestricted. Then we come to January 16th, where we decide to use that inventory. So they use up $30 worth of inventory. And when they use up that $30 worth of inventory, that becomes an expense. So it's over here in unrestricted $30. At the end of the month, you're going to total each one of these, which will be the beginning balance for the next month. And notice that you'll still have $20 in inventory that you haven't spent. Added that to the $100 in inventory that was already there. At the end of the month, you'll have $120 in inventory. Each one of these, expense, expense, revenue. Here, you've got $1,500 in revenue. You've got $1,030 in expenses. So you've got $470 in revenue. And at the end of the month, that's added to the $1,500 already. At the end of the year, you will have revenue minus expenses. If you have more revenue than expenses, you have a surplus for the year. If you have more expenses than revenue, you'll have a loss, a deficit for the year. So, in effect, what we're doing is we're linking the balance sheet, which is assets, liabilities, and net assets, to the income statement, which is revenue and expenses. But every time we record a transaction, we record it in two places. and that's called double entry bookkeeping. So what I want you to do for homework is I want you to do the transactions that are in the chapter on accounting, and there's a couple of months worth of transactions there, and at the end you might be surprised of how confident you feel about the fact that you actually understand the language of accounting. Good luck.